Good morning. Good morning. It is Friday morning. I tell you, it was like 90 degrees yesterday in San Antonio. So live from San Antonio, it's CashFlow Mike. I'm going to assume you can see that because I can. So participants can now see my screen. Okay, so we're going to talk about accounts payable. And if you haven't been to one of these before, we got about 30 minutes. There's no CPE that's involved. But I tell you what, Insightful Accountant is full of great talks, right? They've got a whole series of different things, different places. It's a great place for information. So I'm glad you joined me today because we're going over 12 different topics, right? So I've got a new topic for you every single month for the whole year. So join me every month and learn something new, right? So why am I doing this, right? I'm doing it because, well, I'm on a mission to eliminate cash flow as the reason that businesses fail, right? I don't want a business to fail because they run out of money. You can fail for other reasons. You can fail because the market doesn't like your product. You can fail because you and your partner broke up. You can fail for other reasons, but you cannot fail for running out of money. In my mind, that is a solvable problem, right? So, and here's what leads me to believe this. This number has actually come down. Pre-COVID, the number of business bankruptcies was close to 50,000 businesses a year. And that number, even at 18,000 right now, it's still too high. But here's what I'm saying. It is coming down. People are starting to get it. COVID did one wonderful thing. It taught us that cash flow was important. Even the venture capitalists right now who used to just burn monies, they used to just go on blitz sprees to burn money to get the name out there of their new software, whatever it is, just over and over and over again. They've even changed the way they invest, and they're looking for money back on their investment within 18 to 24 months. So if you're talking to businesses right now, they're wanting to talk to venture capitalists or other investors, they're looking for cash flow positive companies within 18 to 24 months of the investment. So think about that. Now, here's what's interesting about bankruptcies is that banks will tell me that 35% on average, right? It's just kind of a guess in the wind, but they're saying about 35% of the businesses that they see file bankruptcy have net profit on the books. That's the thing I'm talking about. You're making money on paper, but you can't pay your bills. So that's what you and I are here to solve. And one of the key components is accounts payable, and that's what we're going to talk about today. So what is this thing, right? So let's just talk about the accounts payable ratios, turnovers, those type of things. Let's just start there. This is just saying on average about how long does it take us to pay our bills. So the average calculation is just this. And if you didn't know, you were going to do some math today. I've got some heavy math in here because most people don't think about it. They just say, oh, just sit on your invoices, stretch your payables. You're going to get some light touches on strategies. No, I'm going to teach you the math behind why you make certain decisions and how you interpret these things. So basically, accounts payable to me is I directly connected to cost of goods sold, right? Or if I'm in a service company, I directly connect my accounts payable to payroll because those are the direct costs that drive sales, right? You got to remember that. I have to have so much inventory to be able to keep up with sales. I have to pay so much payroll to keep up with sales. That's the thing that drives the business. That's what accounts payable is to me. Now, you can also include things like operating expenses. I like to keep it at account or the direct cost because that helps me manage a line of credit better, right? Because I'm only using it for the actual cash conversion cycle of the sale. And then I use the customer's money to pay back the line of credit. When you keep a straight line like that, only use certain products or loan products for certain things, it helps you bifurcate your business and actually do the right thing by the bank and by you, and you don't get in credit trouble. So this is the accounts payable days calculation. It's days, and I know it's days because it's got this 365, which converts the turnover rate to days. Now, there's a such thing as two different sides of this, right? There's accounts payable days. How long does it take you to pay your bills on average? And then there's the turnover rate. And some people get those confused. They're really telling you the same thing with just slightly different language, meaning your accounts payable days, if it takes you 90 days to do something, that's about 4 times a year. So your turnover is around 4 times a year. And I think it's actually 4.04 if you take 365 and divide it by 90. To convert these things, you go 365 divided by your days or 365 divided by turnover, and that gives you the opposite, either days or turnover. So in this case, we're going to say we got 893,000. If you've ever seen me before, I always drop off the zeros. It doesn't matter because numbers are just numbers. It's just math. So more zeros, less zeros, it doesn't matter. But 893 divided by our cost of goods sold, how much I needed to keep up with my sales is 585. And I multiply that by 365. And that tells me my accounts payable days, or the time it takes me to pay my bills. And let's just say it's 56. Is that good? Fair? Terrible? I mean, what do you think? 56 days if I'm paying it in 56 days. Well, here's what I can tell you about ratios. Ratios don't mean anything unless you compare them to something else, right? So 56 days doesn't mean anything. It just means that's about how long it takes me to pay my bills. Well, it means something if I compare it to something else. And in my case, and in my app or in my courses, I say, let's use the industry average as the bottom, which means we should at least be this, right? So we should at least be paying our bills in 34 days, but we're not. We're paying it in 56 days. Is that good, fair, or terrible? So put it in chat, right? Let me see what you think. Is this comparison, I pay in 56 days, the industry pays in 34 days, is that good, fair, or terrible? What do you think? Right? So what do you think? Anybody? How do you calculate your accounts payable ratio if you're dealing with nonprofits that receive the majority of its cash through donations? Well, I mean, this has nothing to do with your cash collections. It's how long it takes you to pay your bills. So accounts payable is that way. If you're looking at accounts receivable, well, we'd have to look at how those come in. Are they just, if it's accounts receivable, even if you're getting money through credit cards, there is a receivable days, right, of 3 to 4 days. You make the sale on Sunday and you don't get the money till Wednesday or Thursday. There's still a conversion rate of 3 to 4 days. Now, Linda says this is terrible. Depends on intentional, too long to pay, not good. Okay. Here's where I want you to put on your cash flow hats, right? This is where people that are saying this are terrible. And Gloria says some corporations pay intentionally late. Yeah, because that's actually better for cash flow. This is actually good from a cash flow perspective, meaning, yes, I owe the money, but no, I didn't give anybody it. So it's still in the company. Nothing left the company. This is one of those things where it looks like I'm worse than the industry, but I'm actually better because I'm keeping money in the company longer, right? It's one of those strategies called stretching payables. Here's the thing. It could also get you in trouble. So when I'm talking to my clients, I'm saying, hey, listen, accounts payable, we want that to be around the industry average. Why? Because that's what other people expect, and it keeps us out of trouble. And I'm going to go over the pros and cons as well. So good, fair, terrible. We had a lot of people say terrible. I say it's good, right? I say it's good from the cash flow perspective. Now, if we convert that to turnover, just like I said, we're going to take 365, divide it by 56 days. And the turnover rate gets used in a lot of other calculations, right? We can't use the days, we have to use the turnover rate. So that means it happens about 6.5 times a year. If we were paying every 30 days, that's almost 12 times a year, right? Every month. So think about it that way. That's how you take conversion of turnover rate to the days. So what does that mean to you? Well, remember what we talked about last month was the accounts receivable side. Right. So last month we talked about accounts receivable, and I mentioned that it's part of this thing called the financial gap. And the financial gap is the difference between money coming in and money going out. And just like you think about jumping over a gap in the sidewalk, the bigger the gap, the harder it is. Well, that's the same thing in your business. The larger the financial gap is in your business, the harder it is to run your business, right? The smaller the gap, the easier it is, the less money it takes. So here's what I mean by that. Last month, we talked about accounts receivable days. This is just me waiting for money to come in. Well, I overlay that with me paying my bills. How long does it take me to pay my bills? The difference between these two is called the financial gap, right? And again, the way to make the gap smaller is, one, we can collect a little faster, or two, we can pay a little later, which means we're making the gap smaller, right? And the smaller the gap, the less money it takes to run your business. That is how you work yourselves out of cash flow problems. When you see this gap getting too large, And in the course, I teach a concept, or in the app, I've got a calculation called the fast money formula that tells you the exact place that you should be running your business to solve cash flow problems, right? How many accounts receivable days you should have, how much inventory you should have, how fast you should pay your bills, but it helps you work these things out. Now, here's the thing about accounts payable, right? Accounts payable is a double-edged sword, which means that even if you're doing it right and you're stretching your payables out and holding cash in the company longer, it could hurt you, right? And if you pay too soon, if you're too good, if you're paying bills as soon as they come in, that could hurt you, right? The best place to be is around the industry average. That way, if you have to, you can take an invoice and sit it on your desk a little bit longer and keep money in the company a little bit longer so you can work through a cash flow problem. But there's pros and cons to both sides. That's why I say keep it right in the middle. So let's talk about the pros and cons. What if I'm paying too early? Now, this is a lot of text. I normally don't have a lot of text, but I did that so you'd have it in the handout that Insightful Accountant gives you. You'll have a list of this. But some of the pros of paying early is that, hey, people love me. I might even be getting discounts because I pay early. You know, everybody's heard of 210 net 30. Well, I might be saving real cash by paying early. I could actually get better pricing from my vendors. They could actually say, hey, listen, this guy always pays. We're going to give him better pricing than other people that pay late. It helps my credit, right? It helps being financially responsible and gives you more room to negotiate. On the other side, it takes cash out of the company. And that could hurt your cash flow, meaning you might not have enough money to keep up with your own business, your own bills. You might run out. You might feel like it's clunky, like I'm always waiting for money to come in before I can do something else. And if something unpredictable happens, the money's already gone. You've already given it to your vendors, and guess what? They're not giving it back, right? Once you've paid it, you don't get it back. So next, what if I pay late? So what if I'm on the opposite side of this? Well, if I pay late, one of the good things is I'm keeping money in the company longer and I got a little bit more flexibility because I have more money. The bad thing is this. They could give you worse pricing. You could be missing out on discounts. You could actually hurt yourself and your reputation. You could get dropped from a company from being a vendor or being a customer. In the bar business that I ran, you know, back in St. Louis, if you didn't pay your invoices, they stopped shipping to you, right? Which means they just take your product away. And you can't get Budweiser, but from one person in St. Louis. So you're going to actually hurt your business in the long run. So again, stay right near the middle. But the question I always get is this discount you're always talking about, Mike, getting a discount or not getting a discount. Should I pay early and take the discount? Well, common sense would say, yeah, maybe I should do that. Well, here's how you make the decision though, because it's a two-part decision. One is, can I do something else with the money? Two is, should I do something else with the money or should I keep it in the company? Now, it starts like this. There's two calculations that go into this decision. One is called net present value. It's a lot, right? I gave you a lot of text so you can kind of do this on your own, but don't worry. I also got a spreadsheet. If you want the spreadsheet I'm going to show you, just tell me, just email me and I'll send it out to you for free. But net present value is the thought behind money today is worth more than money tomorrow, right? So having money in your pocket today is worth more than money tomorrow. That's basically what it's saying. And it tells you, you know, your discount amount, your discount rate, how long for the discount, those type of things. But let me show you what it is. In this case, I'm going to walk you through an example. If you've been offered 210 net 30, that means I'm going to get a 2% discount if I pay in 10 days. Otherwise, my terms are net 30. I should pay this in 30 days. Well, if I use net present value says I take the discount amount and convert it to how much money would that be, right? That I'm actually going to be saved. What is that $200 actually worth? That's what it's saying. Well, in this case, I got the discount amount. I got the discount rate, right? Comes right from 210 net 30. If I pay in 10 days versus what I normally pay in, let's just say 56 days from the example that we just calculated, and I owe $10,000. Well, we know that if I get a 2% discount, I'm going to save 200, right? 2% of 10,000 is 200. That means I'll actually be paying 9,800, right? Roughly 9,800 when you do all the math. Now, when you start to get into it, it gets weird, right? Because I don't expect you to do this. Excel will do it for you. You got to use exponents. You got to raise to the power of 46. You're like going, Mike, why do you raise to the power of 46? This is 1 plus the discount rate raised to the power of 46. It's not always 46. It is the days of the discount minus the days that you normally pay. In this case, it's negative 46. So 10 minus 56. 10 days is the discount. I normally pay in 56 days. That means I earned $200, the discount, in 46 days, right? Because I would have kept that $200 and then paid it out in 46 days later. So that's how that works. So would I would like the spreadsheet. Yep, got it. Okay. You just got to send me an email so I know who to send it to. So Mike@cashflowmike.com. I'll put that in the chat if you're going to want this. You haven't even seen the spreadsheet yet. You said you want it. So there it is, Mike@cashflowmike.com. And I don't want to send it to host and panelists, send it to everybody. So if you're looking for it, send me a message right after this. I'll send out the things. This is what it's saying, that I can earn that 2% in 46 days. Now, we don't do that. Those numbers are too small and they're weird and things like that. So we don't do that. But if that number ever comes up negative, don't take the discount. So here's what that says in real language. If you know what I teach in the course, is like, what did this really mean? When I did all that complicated, calculation, what does it really mean? It says, hey, if I pay $9,800 today instead of $10,000 in 46 days, I'd get 2% discount for paying early, right? Well, that means if I annualize this, if this is something I do with this vendor every single time I get an invoice, I'd be paying them about 8 times a year, right? 46 days, 365 divided by 46 equals 7, about 8 times a year, I would do this. That's the annualized rate. So that means I'm going to earn, think about that. I know we're saying we're saving it, but in the net present value calculation, you're earning $200, right? By paying early, you earn $200, keep it in the company. So that's a 2.04% return. 200 divided by 9,800. That's 2% return. If I earn it every 46 days, I take this calculation all year long, or this discount all year long. That means I'll make 16% on my money. See, that's how you calculate that. I earn that $200 over the $10,000. So it's 16% per year, because I do it 8 times a year at 2%. Now, this is all you got to decide. Hey, if I can make 16% somewhere else, well, I should wait. Right? If I can't make 16% somewhere else, then I should take the discount. That's what this is telling you. That's why you do this calculation. But if you stop there, you may hurt the company from a cash flow perspective. So it's going to tell you that it's 16% return. And you're going to ask yourself, oh, I got a CD at 20%, which you probably don't. But if I got a CD at 20%, I should just put my money there and make the 20%. Well, this is saying if I can make it more, don't take the discount. If I won't make that much, take the discount. Again, part 1. But part 2 has to do with this spreadsheet and your effect on days cash on hand. Days cash on hand is how much do you actually have to run your business. As a rule of thumb, I tell people to have 45 days or more, right? So when you do this calculation, because days cash on hand assumes you don't make any more sales. That's the problem with that calculation. Days cash on hand says if sales stop or they slow down to almost nothing, this is how long you got to live. So let's not call it days of cash on hand anymore. Let's call it days to bankruptcy. And you want 45 days or more days cash on hand. If you have less than that, you're really putting yourself in trouble, right? So let me open up the calculator, right? And kind of show you what we've done here. So to do that, there it is, the calculator. Boom, pop it open. All right. That's really weird. Probably because I have a massive screen, right? That's probably why it looks so weird. If I do that, maybe that's better. Can you guys see this? All right. So basically, here's how you make this decision. You say, hey, here's my invoice amount. How much are they offering me as a discount? It will calculate up the discount rate. So we don't actually need that to be gray. Every time I do a calculation, I try to make only the inputs gray, and discounted price, you don't need that either to put that in. So I'm going to change that. Okay, so you put in the invoice amount and how much you'll save. Then you'd say, I have to pay this in 10 days. How long does it normally take me to pay, right? So I have to pay it in 10 days. Normally takes me 56, and I don't lock down any of my calculations. So when you get a spreadsheet from me, it's not locked down. So if you mess it up, make sure you keep a copy of it, or it helps you understand what I'm doing. Like 46 days is really C10 minus C9. So it's 10 minus 56, right? C10 minus C9, 56 minus 10, 46. That tells you you get a 16% rate of return annualized. You can see it up here that went annualized 365 divided by 46, right? Just like we did on the slide. Then the amount of the discounts, if we multiply that by 12, 200 times 12 is $2,400 I would earn by paying early. Here's the second part, the days cash on hand. How much cash do you have, right? How much will be there after you pay the invoice? And it says, how much do you owe in annual expenses? Those are the two things you need for your calculation, right? How much do I have? How much do I owe? And that kind of tells you how many days cash on your hand you have. So you have 18 days cash on hand, and after the discount, you'll have 15. This says not favorable to take the discount. It's not favorable, right? Because it's less than 45. You can see in my calculation, I want you to have 45. So if I had maybe 156, there it is. It's favorable to take the discount. So it is telling you when to take the discount and when not to, so you don't put your client in a cash flow problem. Now, this other thing is, hey, the average daily spend. This is how much I have to spend on average just to keep up with my expenses. And this is also saying, if I take the discount, this is how much additional I'll have to make just to keep up with my bills, right? So taking a $200 discount for those 46 days, I have to bring in an additional $213 every day because I let $10,000 leave the company. So what I've tried to do is tell you that, hey, listen, accounts payable is about managing the financial gap, right? Stretching payables when you need to, paying early when it's in your favor, but not hurting your cash flow position, right? So that's why I say, let's try to keep it around the industry average. And when you keep it around the industry average, you got room to move. Hey, I can take a discount when I got the cash, or I can actually stretch my payables when I don't have the cash, right? And this calculator helps you make that decision. When should you do it? When should you not? So let me go back to this. There we go. So what I do is I help train accountants, bookkeepers, fractional CFOs, and all that become better advisors, right? I got a program called The Clear Path to Cash. I've wrote 3 books on the subject. Don't Be a Dumb Business Owner, The 7-Minute Conversation, and Don't Tell Me What to Do. I have a brand new course out there called the Client Conversation Coach, which helps you actually identify the burning issue with a client and solve it using one of the techniques in the Clear Path to Cash. It is the most interactive training course you've ever been through because you choose your own adventure and you get realistic customer responses based on choices you make during the conversation with the course. I also got a podcast. If you like the way we tell stories, I mean, check out Mike and Blaine and listen to our podcast. I mean, it's kind of fun. We've done 186 episodes, so it's been around. And again, if you want that spreadsheet, or you just want to connect, or you want to know more about what I do in full time, contact me at mike@cashflowmike.com. Any questions, comments, concerns, moans, groans, cries, complaints, otherwise. All right, did we do it? Still got your 4 minutes left. I'd be happy to take any questions if anybody's got any. Got there. Want the spreadsheet? Spreadsheet. Okay. Good stuff. Linda, thank you. Great to see you again. Jennifer, thank you. I appreciate that. And okay, I'm gonna give you 3 minutes of your life back and send you on the way. But thank you. This has been another great month for me with Insightful Accountant. It's become a really good partnership. And if you ever want to reach out and talk, or you want to know more about cash flow and advisory services, please give me a call. I'm CashFlow Mike from San Antonio.